All right, folks, thank you for joining us on this December 8th Friday date. And I hope that everyone is ready for the weekend as we roll on in. The jobs numbers came in. The market is reacting. We're going to break it all down here with my new friend here. It's been a pleasure to meet Marcel. Thank you. And we call him the Butcher of Wall Street. Marcel, thank you for joining us on the show here today.
Cheers, Zach. Thanks for having me, buddy.
Yeah, so I'm really looking forward to this. When I started sharing your tweets on my show, and that's how we connected, is that one of our audience members actually got us connected by saying, "Hey, this guy talking on YouTube, rambling on for an hour every night, shared some of your content." And absolutely, man, I've really appreciated your tweets talking about the reverse repo market, this ongoing liquidity crisis. It appears that you have a very good macro understanding. But before we get into the macro, all the data points that are coming out here and the markets, I wanted to talk about your background, who you are, so we can give everyone a little bit of context before we get started.
Okay, well, my name is Marcel Kalinovic. I'm known on Twitter as Boss Blunts and on YouTube as the Butcher of Wall Street. Both nicknames given to me by friends. Didn't choose them myself, but I thought that they were really funny, so I just decided to go with it.
I think we all know how you got that nickname, huh?
I think so. It's pretty obvious, especially if you've seen my YouTube channel. It's very obvious.
Yeah.
But yeah, I'm a small business owner. I founded and operated multiple multi-million-dollar companies, trucking company, logistics company, and a third-party logistics company called Hotshot Expediting and Logistics. I'm also a former PTA president for 3 schools in my kids' district. I did that for a little over 3 years up until the whole C-19 nonsense happened. After that, I ended up moving to a different district. But that was a lot of fun. And after that, I really got heavily back into the markets and no longer had time for it at the new schools and whatnot. So let's just say that when all that happened and in 2019, the reverse repo started to collapse, it really shifted a lot of my focus back into the finance world. I've been trading for over 20 years now. I'm 38 years old, been trading since technically before I was 18. And it really has been incredible to see how the markets have changed over the years, how everybody was affected in 2008, and how what we're seeing now is simply an amplification of the problems that we were seeing back then. And that's precisely why I started doing YouTube back in mid 2021, same as Twitter. I never had any interest in doing it personally, but part of me honestly couldn't sleep at night knowing the things that I know and not sharing it with whoever's willing to listen and willing to learn, because all of this information, just like the information you're sharing, comes directly from our government, our central banks, our 3-letter agencies, and they're always telling you what's happening and what's about to happen before it occurs, but not enough people are actually taking a look at it. And due to my background in business and owning these, logistics companies for over a decade now, I've always spent a significant amount of time doing market research and seeing what the government's reports and bank financial reports are saying to get a good idea of the sentiment for the future. And that really led me to realize that everything that happened with the printing of money in 2020 was directly related to the collapse of the reverse repurchase program in 2019, September to be exact. And it was literally kicking the can, not literally, figuratively kicking the can from 2008 all the way through today. And the fact that the printing of money had to occur to prevent the markets from crashing at that time. And here we are. Thankfully, I get to meet up with very knowledgeable individuals such as yourself. So cheers to you, Zach, and thanks everybody for having me. Appreciate it.
Yeah, well, I think that you're going to be a staple on our show because we appreciate everyone that's smarter than me that puts it all together on Twitter for me to present in my show. And I try to dumb this down and simplify it as someone who doesn't have a background in tech. I've been talking about crypto. As someone who doesn't have an incredible background or degree, but someone who's a small business owner as myself, I relate to where you come from and what you're doing and the need, the desire to put this out there. It's funny when you put your own skin in the game, when you got your own money on the line, how quickly you'll learn those lessons. And so I'm always trying to talk to people that have more experience than me, not just in business, but in investing as well. And then someone who understands macro as well. We're going to have a lot of fun here in this session, folks. So I wanted to start here by breaking and simplifying down the reverse repo market and what we're seeing, because I've been telling folks on my channel that we got an ongoing debt, currency, and liquidity crisis. You can dissect each one a few different ways, and we can go down each one. But I wanted to highlight the liquidity crisis, the reverse repo market. I've explained it to folks this way. I say these are short-term overnight loans that the banks are doing to basically cover their asses. So can you add on to my simple definition on what the reverse repo market is and what we've recently seen as far as the drawdowns on that?
Absolutely. And, much like I do have a background in network engineering in the past before I got into what I'm currently doing. I'm a former real estate broker as well. So I do have a really solid understanding of these markets and some of these programs as well, simply through my investigation into them over the last couple decades. But to add to your point on the reverse repurchase program is not the same as the repo operations program. They are very similar, but kind of opposite ends of the spectrum. The reverse repo is when money market funds are basically money market funds, which are mutual funds, using the reverse repo to invest their excess cash in overnight treasury bonds. And that's highly liquid. That allows them to stash, sometimes hundreds of billions, if not trillions of dollars collectively into this overnight repo program, reverse repo, I should call it. And then the following day, they basically return it back to the Fed for the federal funds rate plus 0.05% APR as an interest rate. So they are making some money off of it, but it's not necessarily the fact that they're getting free money from the Fed to fight against inflation, because they're getting the Fed funds rate plus 0.05 every single day on all this money, but it's also a massive amount of excess cash that they can store away in these highly liquid reverse repurchased agreements through these treasury bonds. So that basically allows them to store this excess cash to maintain their collateral requirements to prevent margin calls in their mutual funds.
Okay.
And the opposite of that would also be the repo operations.
Okay.
The repo operations are mostly used by banks, and that occurs every time the bank's having a liquidity crisis. So we've seen just a couple of days ago that the repo operations went from $0 to $200 million overnight, and that's the highest it's been since the C-19 shutdown lockdowns, because there are definitely some issues there with liquidity on these banks. That's not to say that banks can't also use the reverse repo program, because they definitely can. Hedge funds, mutual funds, all the shadow banks in the banking sector can invest excess liquidity, excess cash into the reverse repo for the overnight. And that allows them to maintain their initial margin and margin collateral requirements. And they could also dip into it even further through the repo program in order to take out extra cash and liquidities to maintain themselves from getting margin called. So they're both correlated in opposite ways. I didn't mean to cut you off there. No. Let's put a decrease in the reverse repurchase is bearish for the stock and bond markets. And an increase in the repurchase, which is the repo, is also bearish for the stock and bond market, both of which are bullish for heavily shorted equities and assets, such as precious metals, meme stocks, inverse ETFs, and inverse indices.
What about crypto?
Absolutely.
Yeah.
Absolutely. It all depends on the levels of usage of the crypto. If it's heavily shorted as well, which it's harder for retail investors to be able to short crypto, but it's a lot easier for institutions to do so. So yeah, if there's, something like, for example, whatever, Dogecoin or XRP or something that's being manipulated to the, being heavily shorted, it has a lot of potential for upside movement, because when margin calls occur, it creates a fire sale of assets situation. And those assets that are sold off are basically a lot of long positions, blue chip stocks, the top 7 in the S&P 500, bonds, and so on. And that money is then used to repurchase some of the, or should I say, to purchase some of those positions, the securities sold that have not yet been purchased, shorts, naked shorts, et cetera, regardless of asset class, whether it be precious metals, crypto, or equities.
Yeah, and it's interesting because I've been saying how there's so many different ways that they can inject liquidity or backstop the system now that it's easy to get all these different terms confused, right? Most of the masses, I mean, they're just trying to make sure that their 401k is still going up when they check on their financial advisor twice a year, if they even do that. Because we know half of America doesn't even know what their 401k is even in. But now that we've had the worst year for the bond market last year, the third worst year in history for the 60-40 traditional portfolio. And as you said, after I call them the simulation events of 2020, after that occurred, a lot of people woke up and they said, oh, crap, what's going on here? Now, we had a V-shaped recovery. Stocks went up, the equities went up, and the real estate market went up. The problem now is this ongoing liquidity crisis, and the unrealized losses that these banks have just on their bonds alone is now $684 billion, is what some of the most recent numbers were. And then you add on the bad loans, the bad exposure that they have to real estate as well. So this is a debt crisis, and it fuels a liquidity crisis. And this has kind of been a really volatile time for the past few years, where I think now folks are just trying to find, what does this even mean? And then when you go to try to decode all this data and figure it out, it's pretty difficult, right? And they've set up all these new backstops. They've set up all these new facilities. And so as you're highlighting right here, we're back to levels that we haven't seen since during that time. And I thought that it was very interesting when I was bringing you on intro, just how you said how the crisis already started in 2019. Many folks don't realize that. See, whether it was a simulation event, real, not real, or to what extent, what you had is you had the collapse of this taking place in 2019. And what people forget is that the Fed started to raise rates under Trump's term, and he was saying, well, hold up here, right? And they did it anyways, and just that little bit of a bump started to break things, right? And that happened in September of 2019. So go back to that point in time, what's taken place over the last couple of years, and then to the level that we find ourselves at now. It's been a very interesting ride over the past few years. So can you maybe break down how it started in 2019 and where we're at right now with it?
Absolutely. That's a long explanation. I'll try to make it as simplified as possible. But basically, I think it was September 19th, 2019, there was an explosion of the Federal Reverse Repo program, in which banks were unwilling to lend before the Fed took it over, occurred through banks. They were unwilling to lend their treasuries at the federal funds rate that they wanted to. That was closer to 2% at the time. It went as high as around 11, 12% before the Fed decided that they had to step in order to, this was all occurred in one day, in order to prevent a complete crash of the repo market, the bond market, and the stock market. They managed to take over the reverse repurchase program and fund it directly through the Federal Reserve. And they realized that they would have no choice but to pump hundreds of billions, actually trillions of dollars into the system, into the monetary system, in order to prevent a global financial collapse, which would obviously be one of the worst things for America, because aside from the U.S. Army and the U.S. military, America gains its power from the United States New York Stock Exchange and the stock market. So they definitely had to maintain their positions there and keep everything as even-keeled as possible. And the only way that they were able to do that was by using the lockdowns and shutdowns to sort of destroy the market from a retail investor's perspective, which caused a lot of retail investors that were unsuspecting at the time to lose a vast majority of their 401k, pensions, thrift savings plans, IRAs, et cetera. while the banks left them as bag holders and repurchased back into them at the low levels that we saw after a lot of people lost a lot of money. So they ended up printing more than 33% of all dollars in existence in a period of about a year and a half, which led us to the inflation that we've seen over the last couple of years.
And that we're still seeing, right? We're still feeling the impacts, right?
We're nowhere near done with this, man.
Yeah.
You're right, Zach. This is not even close to being over. The everything with the CPI is a complete lie. People believe it to be, it's 3.5%, 3.5, the level at the CPI, which we all know is greatly manipulated because every few months the Fed comes in and changes the weighting, the WEIGHT weight of the items within the CPI. They change the calculation. And if everything was calculated the same as it was in the 1980s, it would currently still be above 12 or 13% if they hadn't changed the definition and the reweighting so many times.
How high would it have gotten?
It was well over 20.
Yeah, right. The highest over 20. Okay, sorry to interrupt. But yeah, because we got up to 9.1% reported CPI lie, which at the time I was just saying we need to double it and then round up. So we might as well just be at 20%, right?
It was way higher than 20% at its heights. Absolutely. And that's all directly related to the fact that the American people got, $800 or $1,200 in C-19 bailouts, and all the biggest banks and insurance companies and financial companies received billions and billions of dollars in bailouts. But everybody was okay with that because they got a check for $1,200. And people didn't realize what guys like you and I did. And that's not a jab at anybody. That's just a fact, because we were actually looking at the numbers and the reports coming out from the bureaus here were really clear that the GDP of the United States and the inflation levels were about to reach a point of no return. And that's exactly what happened. We saw the hyperinflation coming. We saw the reduction in our gross domestic product coming as well. And currently, much like the CPI, the GDP is a complete lie as well, because the government is propping up the GDP of this country through government spending and an increase in hiring, 87,000 IRS workers and other government employees. All of this government spending and sending money to Ukraine shows up in the GDP as a positive number, and that artificially inflates the GDP of this country to make it look as if we're not actually in a recession, which we have been for quite some time now.
And last year when we met the technical definition of a recession with two negative quarters, Q1 and Q2, that one offended too many people, and we got to be careful that we don't offend anyone. And if a data point doesn't make you feel good, you just strip it out, like you've been saying. And it's crazy to me that we got talking head pundit Paul Krugman, who wants to strip out energy, shelter, food, and used cars to come up with the super core. And it's like, what reality are you living in? You're stripping out everything that matters. And what are we talking about here? And so that's been hilarious to watch. But to your point, you ran us up to where we got to, where the Fed had to stop inflation. So what did they do? They raised rates, I believe, at the fastest pace in history, from about 0% up to 5%. And the question now, the trillion-dollar question that everybody's trying to figure out is, has the Fed done enough to fight against inflation? Now, we know what Main Street, we know what our stock, the Wall Street boys and girls want. They want Daddy Powell to ease up here and literally turn back on the money printer to pump their stocks, even if it means inflation coming back, because these people are so desperate. And let me be just careful here. There are good citizens, good Americans with 401k and retirement accounts who did the right thing, but they've trusted these financial advisors for too long, and now we've seen the system break. And as you said, the average American's getting caught holding the bag, and we just tracked how Americans lost 5.9 trillion in wealth last year. So it was a rough year for them. We talked about the balance sheet that the bankers have. It's a rough go at it for them. But this time around, they've set it up for bail-ins. So once again, it's going to be Americans caught holding the bag. And if we have to take some of your deposits too to bail out the banks, we'll do that as well. That's now how it's been set up. But the question I wanted to ask you is, has the Fed done enough to bring inflation back down here? And then we're going to get into the jobs numbers too.
Absolutely not. Absolutely not. They raised at the fastest pace in history and then stopped raising because the Fed is always looking at lagging data. They're scared to break something, but the Fed has already broken it. That they just don't realize it yet because it hasn't completely materialized yet. We've all seen what's happened with SVB, Silvergate, Credit Suisse, and so on. All these banks, First Republic, FTX, crypto exchanges like them. And just 3 days ago, Bittrex, the latest crypto exchange to go bankrupt and be declared insolvent, is also shutting down. But it's nowhere near sufficient. Inflation, like you said, is right around 3.5 for the CPI. And those numbers are completely skewed because they've reduced the weighting and the calculation of the top two and the top three expenses of Americans. The first one is housing. They reduced the weighting and the calculation to make housing less impactful on CPI. And housing inflation for both mortgages and rental is through the roof. Let's not even get started on taxes, but we know property taxes, yours and mine and all of ours, have gone way higher this year than they did in previous years. And then also energy. Right now, fuel is a little bit lower because there's absolutely no demand in the trucking industry, that I can guarantee you myself. Well, very little compared to what there should be, at least, especially in this season. But as far as gas prices, natural gas prices, propane, kerosene, heating oils, electricity, coal, all of this power is also through the roof. And again, same thing with the CPI. The weighting has been adjusted to reduce their impact. And then food, same thing. The weighting was adjusted to reduce its impact on the CPI, when those are literally the 1, 2, and 3 in that order, top 3 expenses for Americans.
Yeah. And really,
there's no way that's right. It's wrong. It's criminal. It's immoral.
Yeah.
And it's harming people. But even having done that, Zach, it's insufficient to bring inflation down to the 2% rate that the Fed is trying to reach, because right now they're doing a burnout, like in your car. I call it it's a brake torque. They got 1 foot on the gas and 1 foot on the brake pedal. They're doing quantitative tapering, trying to write down their balance sheet. They've written down only 10% of their $2.7 trillion worth of mortgage-backed securities, in which they're selling off. And they're also printing record amounts of money to go to Ukraine and other countries around the world, and here in the United States to illegal migrants and so on, and other government programs that don't help average Americans. They help other countries and illegal migrants. However, all of that is still impacting inflation. It's a foot on the brake, a foot on the gas at the same time. You can't do QT and QE and expect anything less than continuing runaway inflation. Meanwhile, our economy is stagnating. That's the literal definition of stagflation, like we saw in the 1970s.
This is going to be the worst case scenario, because stagflation is asset prices going up while demand's falling off. And that's going to do here is really divide us between the haves and the have-nots. And because the asset prices are going up and nobody can afford it, right? Nobody can afford the average median home now, right? The unaffordability is at its worst level ever on real estate. And we'll talk about that. But I wanted to talk about this jobs numbers. This just came out today, the jobs report. We have unemployment coming back down from 3.9 to 3.7%. We get 199,000 jobs added. Everybody's happy. Everybody's cheerleading. But when we look a little bit closer, the devil's always in the details, isn't it? And what we find is that nearly a quarter of the jobs added come from the striking auto workers and the filmmakers in Hollywood. But to give us a real glimpse at where America is at and where our dumbed down population is at, today it's announced that Matheson Trucking shuts down, and we're going to be losing 3,500 truckers. But don't worry, America. We get more woke films coming out of Hollywood, and they are back to work. Everybody should be happy, slappy. warm and cozy at home for the Christmas and the holidays. Probably shouldn't call it Christmas because we might offend somebody, but everybody should be cheerleading Bidenomics and having a good time. The jobs are back. What do you have to say on that, Marcel?
You're absolutely right. The jobs report is a complete farce. And aside from that, almost every single jobs report we've seen over the last 2 years has been revised very quietly to the fact that most Americans don't even know it, but they've all been revised to the downside after the fact, claiming we overstated our jobs numbers, there was misinformation in the jobs report, et cetera, et cetera. And the vast majority of people pay zero attention to that. They don't care, because all that matters, all they want to hear is what the Fed comes out to say. What the mainstream media comes out to say, saying that the jobs report looks good when every month when they're trying to report it. It's an absolute farce. It's an absolute lie. And to your point, we were talking also about the jobs report being artificially inflated through the striking workers from the auto unions. That's people that are jobs added, which is not the case, right? It's simply jobs coming, people getting their jobs back, right, Zach?
Right. And they're going to be getting paid way more, which who's going to end up paying for that? Yeah.
This guy, that guy, all of us.
Yeah.
We're all going to pay more for that.
And to be clear, we're not against people getting their fair wage. It's just, how is this actually going to impact? Like, what's the ripple effects?
People don't realize that the workers' strike for auto workers was actually inflationary, because even though those people were out of a job, there was fewer auto parts going into the market. Therefore, now when you have to get auto parts, if you're even a little bit unlucky, you take your car to the dealer or you go to the AutoZone or whatever, they may not have it. So then it has to be procured from somewhere else. And because of the lack of supply, the increased demand has allowed them to raise the prices on all of these auto parts. And it is literally an inflationary unemployment that occurred there. And then on top of that, we also have to pay for the increased wages through higher prices of vehicles and taxes on those vehicles, because the higher the price of a car is, the more we have to pay in taxes on it as well. So it's multiple layers of inflationary problems that we're seeing here, just from the auto unions workers and getting their jobs back and going on strike, whatever, as well as the film industry, film writers and so on. Yeah. So it's all going to have a knockdown effect.
Yeah, we were really missing those film producers, weren't we? It's the same thing, though, that I've been saying with the McDonald's workers. They're going to get paid their $20 minimum wage now. Well, your Happy Meal is going to cost you $20, So, and then they're just going to end up getting replaced too, through the automation as well. So,
man, you know what, Zach? I actually went to Five Guys yesterday, and they were selling a single cheeseburger with no fries for $18. And
holy
I actually
cow.
the fries were $4.99 and the drink was $4.50. Honestly, I was like, I'm not about to spend $25 for a burger and fries. I walked out and went to Whataburger, and I got one for $10.
Yeah. I know. And this is the thing, is now it's becoming so costly to even feed the family at home, let alone whether you can even get good quality stuff too. That's a whole other rabbit hole that we could go down. But in regards to this jobs numbers, this is what I see is all I got is a bunch of cheerleading by FinTwit bros, right? Financial Twitter bros, that all they care about is their stocks going up. They don't care about the ramifications for inflation and the pain that's going to be brought to Main Street, because they want their allowance money to go up or whatever their deal is, right? And I think that for me right now, what I'm watching is a final gasp of air for equities markets before the Fed does come in and have to cut rates. And my prediction is that we get some sort of black swan, some sort of catalyst between now and maybe Q1. I really think that we're in prime black swan season. And I think that we're already going through multiple black swan scenarios with the World War III events, Russia, Ukraine, obviously still going on, Israel, Gaza, China, Taiwan. Now there's a little skirmish in Venezuela as well. And I say skirmish lightly, but this is a powder keg that can blow up at any time. And to the point of inflation and the how, this is going to affect us back home, if any of these actually accelerate or pop off to another level, it can quickly be a catalyst to send things off once again. So I wanted to get your thoughts. For me, my prediction is we get some sort of catalyst that comes in, and it's the excuse that the Fed needs to come in and ease it. And it happens between now and the election. I tried to narrow the time frame for the audience, but just between now and the election, we get an excuse for Daddy Powell to finally ease up on us and start cutting rates. But what most people miss, and what I'm trying to remind everyone of, when that first Fed cut comes in, the bottom's probably already falling out on the equities market. Your thoughts on that prediction and what you see for this 2024 election cycle?
Okay. Well, let's put it this way. Moody's just came out and downgraded the entire country of China from stable to negative. They said that, I'll quote, risks to growth stem from reform and deleveraging challenges while economy transitions away from property, exacerbated by a lack of predictability of government decisions. A lot of what you said, all of what you said is completely valid, but a lot of people are also missing the fact that there are black swans that are called that because nobody sees them coming, and including the central banks and such. And sometimes they see them coming and they're waiting for them to take effect because they want those things to actually happen. You know, currently, global banks hold over $1 trillion in bonds and loans of Evergrande Real Estate Company and their electric vehicles division. And that's just one company. There are hundreds of Chinese real estate firms that are in the same position as Evergrande, who is currently facing insolvency in bankruptcy court come January. They've been kicking this can down for 2 years now.
I got to pause on Marcel, because there's a bunch of people that have been saying that Evergrande's a big nothing burger. And it's like, no, they're still going through the bankruptcy filings and they're having issues. Your tweet where you highlighted how they just pushed it back just reiterates the point. They're kicking the can down the road and they got no buyers either, right?
Oh, absolutely not. Absolutely not. There's nobody buying that garbage. Their stock is worth about 3 cents, and for a good reason. Nobody's going to buy it, but BlackRock and Ashmore Group are the top two holders of Evergrande bonds. They've got billions and billions of dollars worth, and all of that would have to be written off at a value of absolute zero, which even currently it's still maintaining some of its collateral value for ISDA banks. So they're using that as margin collateral. And if and when Evergrande gets declared insolvent in January of 2024, all of that would be written down, causing greater liquidity issues for all these banks. And that's just one. There's Country Garden, there's Sunak Group, and many others. Go ahead.
Yeah, no, I was just saying, yeah, that's just one of many. And you said it's about $1 trillion.
It's over $1 trillion, way higher.
And you pointed out the ISDA, which is the International Swaps and Derivatives Association. Funny that you mentioned that, because we've been talking about this in the XRP community. Ripple just got added to them. And so that was another key partnership that we got over here in Ripple XRP world. But the International Swaps and Derivatives Association, you're talking about $1 trillion worth of derivatives. And this is just one company, to put it into scale and perspective, right?
Just one, exactly. And their bonds and loans are held by hundreds and hundreds of banks all around the world, American, Asian, European, and everywhere in between. Aside from that, the top 4 banks in America alone have a value at risk of over $720 billion just from the top 4 banks. And then if you take the top 4 banks and you look at their total derivatives exposure, the notional value of derivatives exposure for the top 4 banks, that last quarter, that number was at 193 trillion with a T. This quarter, that number is over $210 trillion in total notional derivatives exposure to just the top 4 banks. There are 1,189 total banks and holding companies in the derivatives market. So that kind of gives you a small indication of just how heavily over-leveraged and rehypothecated all of these banks are. Everything in the banking sector, in the financial sector, in the real estate sector is interconnected. So people that are claiming that Evergrande or that Sunak or Country Garden or any of these is a nothing burger are the same people that were probably wiped out in 2008 because they're unwilling to look at the facts. And the facts are that even if that doesn't occur and the Chinese government happens to give them billions more in bailouts to kick that can further down the road, there's nobody buying it. Nobody's buying their homes. Nobody's feeding into the Ponzi to give the developers more money to finish the apartments that have already been started, because that's how that whole game actually went for them. And to your point about housing a little while ago, the housing correction in new home sales in the United States are already down 20% year over year. In China, they're down 4 or 5% per quarter. Sorry, not per quarter, even sometimes even per month. China has been having massive drawdown in their residential real estate. Here in the United States, residential real estate in many places is already down 20% year over year. Commercial real estate is in the absolute gutter and has a long way to fall before it reaches the bottom. Existing residential home sales in the United States have already collapsed. Remember, I said existing home sale numbers have already collapsed. The number of homes, not the price, to 2009 levels. And the existing supply of homes has also begun to increase.
But
Go ahead,
the existing home sale price is still up 3%. So
got it.
It's always a good time to buy. And to your point, the same people, right, that say Evergrande's a nothing burger were the same people that said that we were going to get Fed cuts this year in 2023. And how many Fed cuts have we got? 0. And these are the same realtors that are going to tell you, and I'm already seeing the emails circulating from realtors telling folks that the government is guaranteeing 6 cuts next year. This is the type of manipulation. It's crazy in real estate, that manipulation there.
I told you I used to be a real estate broker, and never in the world would I try to get people to buy a house in the current market, because to tell people that you'll be able to refinance later when they cut rates and so on is absolute nonsense and a travesty, because you could say that now and you can count on the Federal Reserve, when a black swan occurs, cutting rates. But even the European Central Bank has come out and said that whenever the Federal Reserve and the central banks pivot and cut rates, the stock market almost every single time, the stock and bond and housing markets collapse even further to lower levels after the Fed pivots into rate cuts. And so they're all betting on these bailouts. The thing is, when housing loses value, it doesn't matter how good your credit is or how much money you've got in the bank if you can't pay it off in cash. Because if your home loses a significant amount of value and your house does not appraise for the amount that you owe, you will not be able to refinance no matter how low the the interest rate is. You cannot refinance if you purchased your home for $400,000, it's currently worth $325,000, and you still owe $350K unless you pay up all of that $25,000 in cash upfront to meet the current appraisal price. You will not be able to refinance. And if the pivot always precedes the market crash, like the European Central Bank has told us, and like the numbers and the charts have told us, that means that after the pivot, housing prices and equities prices are going to go down even further, are going to continue to reach lower levels. It's going to put refinancing even further out of the reach of majority of people. And as that happens, a lot of people may no longer be able to pay their mortgage, especially with, like you said, like Matheson just today, laying off 3,500 employees. What was it? Bittrex going bankrupt and insolvent and laying off all of their employees. And who was it just yesterday? State Street Bank, who has massive short positions on meme stocks such as GameStop and AMC, just is laying off an additional 1,500 workers. Charles Schwab just laid off 2,000 people, and so on. And right, we could talk about that all day. Then you've got Yellow Trucking, who just a couple months ago laid off over 30,000 employees because trucking is in absolute shambles. Trucking is always the canary in the coal mine as far as this country goes, right? And I know this from a fact, through the fact that I've been in business for over a decade in the industry. And it happened in 2016, it happened in 2019, and in 2020, we were seeing hundreds and hundreds of corporations going out of business, becoming insolvent, laying off millions of people. And at the time, we were still undergoing record low interest rates, the ZIP policy, zero interest rate policy, that is currently impossible due to all the factors that you mentioned, Zach. Because if we go around and reduce the interest rate now, it's just going to lead CPI and PMI and PCI much higher than it currently is anyway. So it's going to lead to further hyperinflation, getting the Fed further away from their federal funds rate target. They need the market to crash. They're expecting the markets to crash before they pivot, or at least have some sort of black swan event. And then they will continue to reduce rates from there as the demand is destroyed more so than the supply. It's a hot fucking mess, man. 2008, but the issue is that it cannot be saved by printing more money, because that's just going to exacerbate the current problems that they have. And all of these banks and these FinTel bulls and these everyone who's super bullish on the stock market and the equities markets are all betting on a federally funded bailout that is literally impossible without creating more inflation.
Right.
It's crazy.
So I think that we've laid it out pretty good, kind of where we're at, and I want to peek into what happens next and what we can do to prepare for it. I wanted to get your take, though, because it seems like you understand this whole meme stock craze pretty well, too. This thing's starting to kind of unravel, and I just watched the Netflix documentary. It was pretty cool, I guess, and it kind of reminds me of what we've been doing here in the XRP community. We've been bag holding this dang new world reserve currency for years, hoping that it's going to do something, and I firmly believe it will. I believe that it is one of the most manipulated assets in the world, very, very suppressed, and the SEC lawsuit was definitely part of that. Now that we're on the other side of that, I'll talk more about that later. But as far as this stocks, the unwinding that we might see, and the heavily shorted stocks, how does this end up playing out? And if you care to share any positions that you may have in that regard too.
Yeah, absolutely. Basically, we also saw the the Bank for International Settlements on Monday come out with an article on Bloomberg, almost mirroring word for word a tweet and a video that we did on Friday. And they said that central clearinghouses that hold over $1 trillion in liquid assets may exacerbate periods of financial stress, creating margin spirals that could push down asset prices. These are researchers for the Bank of International Settlements. All right. And they also warned, let me see here, I've got it written down. They warned that liquidity needs may force life insurance companies to recognize currently unrecognized losses. Those are the exact losses you were talking about earlier for some of these banks and insurance companies, to the tune of $690 billion. What is that, from one quarter alone, if I believe, or as of right now?
Currently, it's been fluctuating over 500 billion, and that's just within the banks. That's just the banks.
Right. So these central counterparty clearinghouses, they're known as CCPs, increase the margin requirements on its members, such as banks, prime brokers, stock broker dealers, crypto broker dealers, etc. When that happens, this leads to fire sales in assets, blue chip stocks, Bitcoin, things like that, things that people hold long, bonds and so on, and derivatives markets. And as investors dump those, it causes a collapse in prices of those assets that are held mostly long, because they need to raise funds. Increases volatility and triggers further margin calls from other funds, insurance companies, mutual funds, prime brokers, family offices, hedge funds, and so on, that hold those as collateral. That creates a domino effect where one fund makes a fire sale, another fund gets margin called, they also create a fire sale, another fund, and so on, right? Then in turn, at the same time, the first fund is going out and closing some of their short positions. That means they're buying back some of the securities that they've sold but not yet purchased, whether that be XRP, AMC, GameStop, PSLV, precious metals, paper contracts, silver, gold, etc. And that creates a skyrocketing in the prices of those heavily shorted assets. Again, in turn, that creates another domino effect similar to the first one that we saw. That the first domino effect, where funds that are long on the assets that are being fire sold also have to fire sale and close short positions. Now, the second domino effect, where the margin calls are creating a situation where they're purchasing back their securities, other funds that are shorting those securities as well, then they are also going to be margin called by the central clearinghouse counterparties. And it creates a massive weave. It's a huge intermingling of the assets and shorted assets of these funds that creates simply a situation of fire sales, margin calls, and buybacks of heavily shorted equities, and it's going to be a fucking mess. I hold a lot of precious metals. I hold a lot of meme stocks. And I knew coming into this in 2021 that a lot of my meme stocks positions were going to lose value over time. So I left myself with excess liquidity with which to dollar cost average down on them until this finally occurred. I have absolutely zero faith in the stock market and the bond market in their current setting because of everything that's going on with these over-leveraged funds, whether they be insurance companies, non-financial institutions, mutual funds, money market funds that BlackRock and Vanguard are trying to convince you are good investments right now, which they're absolutely not, because they also are at great risk of this margin call, or whether they be blue chip stocks, because they are all artificially being pumped by the same hedge funds. There are way too many funds in the same asset classes now in the greatest, largest asset bubble we have ever seen in the history of the world. And that's unsustainable at the current rates So I have absolutely complete faith that cryptos like XRP and meme stocks like AMC and GameStop and many other cryptos and meme stocks, and then precious metals and other heavily shorted assets, whether you look at inverse indexes like the VIX or inverse exchange traded funds like SQQQ or the UVXY and so on, are going to skyrocket to new all-time highs. Period. And it's not an if for me, it's a when. And I'm not a financial advisor. I'll preface that this is not financial advice. But for me, it's an absolute inevitability, and I will definitely bet on that.
Well, we can check the box on gold, right? Because that's already happened here just in the last week. And
I think it's got a lot further to go, to be honest with you.
And that's the thing, is we're just getting started. I mean, that gave you a little glimpse into what's coming, right? And so then they came back, they bring this thing back down to 2,000 at the time of this recording right now. Mm-hmm. And silver's back down to $23. And I've been telling my audience, I said, guys, take advantage of these opportunities. If you've been looking to get in these assets, we got a glimpse there, but this wasn't it. And we expected that pullback, and it's played out perfectly here. That really shocked a lot of people, though, I think. And the fact that oil was falling off while OPEC's already doing more production cuts, and the fact that gold already made a move, was massive indicators for me of the looming recession that we have, right? You don't have guys on Robinhood that are really getting, trading the oil market per se, right? I mean, they might pick up some stocks of some oil companies, but when oil traders are showing you and oil's falling off during this, and maybe that's just going to be part of it, because if we do get a weakening dollar next year with the Fed pivoting potentially, then we could see oil go back up once again. But nonetheless, let's get. I wanted to get your point on the stocks here that you're looking at. So you have positions in AMC and GameStop still, and you're saying that you knew that they were going to be drawing down, even after all of the hype and the mania that took place in 2020. You knew we were going to draw back down, but you're continuing to dollar cost average into that because you think that we're coming to an inflection point where basically they're going to be cascading margin calls amongst these hedge funds, amongst these banks, basically the whole system. And these are set to explode once again. So can you run me through that thesis once again?
I could spend hours talking about it, so I'll just oversimplify it again. I could take my money and put it into a mutual fund or put it into the S&P 500 and get, 5%, 8%, 12% for a period of time. And at some point, there's going to be a correction. In my opinion, the greatest correction that this world has ever seen in these asset classes. So if at that point, at the end of the day, I'm down 80, 90% after having only made 5 or 8 or 10%, what is the point? For me, the thing about black swans is there's never sufficient time to get out because they almost always occur in the after hours, in the pre-market, or over the weekend. Like Lehman Brothers, Bear Stearns and stuff like that. That wasn't happening in the middle of the day where people could just go out and sell off their assets and say, okay, great, I'm fine. Perfect. I came out clean. You have to be in position before it happens. So in my opinion, either you're early, which means you're on time, or you're late.
Right.
And there's no just in time. That's not going to be the case in my opinion. So just like I got a ton of this. I've got a lot of silver and metals and stuff like that.
How big of a bar is that?
This is a kilo bar right here.
Oh gosh, you're making my little bar over here look so tiny.
Oh no, I got the little ones too. I just like these kilo bars because they're pretty. You know what I mean?
I need to give me some of that.
Yeah, this is real money.
Yeah,
we were buying them last year for $17 an ounce. Then we saw them all the way as high as like $29 an ounce, 28. And right now, you said it's $23. It's just a pullback. It's just another correction. Just like the meme stocks and XRP shot up, had a pullback. It's the same thing with silver and gold. Mm-hmm. They shot up and had a pullback. And it's the opposite with the S&P 500 and the NASDAQ and such. The top seven stocks in the S&P are holding it up.
These are inversely correlated against the system being fine, and basically the main street pump is gold, is silver, is XRP, some of these other plays, and even the meme stocks too, like you're talking about. And so let's hone in on predictions for next year. I laid out where I think this is at. I think we're watching catalysts already unfold that you could call black swans, that you could call systemic catalysts to break the camel's back. And so let's hone in right now. We have a Fed FOMC meeting coming up here on December 12th and 13th. What is our prediction on that, and what's going to be the impact of the markets through the beginning of next year?
I just want to finish off. I forgot to add a point there. The whole point behind what I was saying there, it doesn't matter if I'm up 5% or 10% or 15% in the short term, if at the end of the day, after the long term, my assets have collapsed with the collapsing bubble. I would much rather be in position, dollar cost averaging now, with money that I was previously keeping in the bank that was getting torn away by inflation, doing me absolutely no good. I'd rather invest them in silver and meme stocks and cryptos and other asset classes that I believe have a much higher return potential than 15%. So I'm more than okay with holding those funds there because of the changes in the markets, like what you just said, and my predictions for the future with the Fed.
Well, if I may, we just highlighted at the beginning of this that real inflation is 10 to 20%. If you're not making 10 to 20% on your returns, you're not breaking even. So what are you trying to do? These geniuses think that they're just having the time of their lives buying bonds at 5%. And I'm laughing because I'm just saying you're losing, right? I mean, at least that you're getting something, I guess. You're not losing as much. But I'd rather remain liquid or buy assets that, like you said, you might not be able to get into if you wait around. And we've seen deficits already, a 230 million ounce deficit for silver. We know that these happen overnight when the markets are offline, and you're not going to have access to buy in, when the inflection point hits. And so to your point, I'd rather be early than miss the train completely.
Yep, that's absolutely right. I'm predicting, like we were talking about the central counterparty clearinghouses, the total collateral in the global CCPs as of mid-June was $1.3 trillion. And that's made up of predominantly in cash held at the central banks and the reverse repo, as well as government bonds, according to the Bank of International Settlements. That's about 10% of all the high quality liquid assets that are held by the global systemically important banks. So when we have situations, black swans that occur, that money is not going to be available. That money is going to be tied up, and it's going to force these banks to go into the repo market, not the reverse, but the actual repo market, and borrow more money from the Federal Reserve in the form of overnight liquidity, overnight bonds. And again, it's not until we see that black swan, it's not until we see that occur that there's actually going to be a proper pivot. And it's highly likely, I'm predicting that there will be a black swan that will cause a massive downturn in markets when the Fed will pivot. And then it's after that pivot that markets will continue to collapse and collapse even further, that we'll really see the Fed start to cut and cut and cut further, because they need that. The Fed needs people to become unemployed. They need people to lose their homes. They need people to lose their cars and all of these things and lose their excess funds. That they call it disposable income. But I don't know about you, but I don't have any disposable income. None of my fucking money is disposable. Pardon my French, but that's what they're calling it, because they know that Americans are spending that before they go broke, and they need that to happen for inflation to come down, for them to meet their goals. And it won't be until that occurs that the Fed actually does make a complete pivot, because a halting of rates currently is not a pivot. Like you were saying about the Fintel group and the bulls and stuff, we're saying that the Fed pivoted because they're not raising rates further. No, not at all. They're just taking a break. They're taking a breather and seeing what happens. And the way that the stock market has rallied, and even though we all know that these job numbers are fake and everything's going on and inflation's artificially depressed, that's the opposite of what the Fed currently wants to see. So I won't be surprised to see another 0.25%, another 0.25% raise by the Fed, either in December or January, before they actually have another halt, waiting for that black swan. And then possibly, just like you were saying earlier, and they will allow the black swan to take hold so that they can come back in, save the markets with a bail-in of taxpayer dollars, of bank depositors' money, use your money to bail out the banks, to bail out the institutions, further deflate the value of a dollar, and come in and say, we saved you, America. We saved your deposits. Who cares if inflation's at 10% again? We did it. Vote for us. Vote for the Democratic Party. We are your heroes. So people are trying to say that the market isn't going to crash until after the election, but we've seen it in the past where the market is allowed to crash immediately before, and then the central bank comes in, saves the day, and acts as the savior for markets.
That's basically what happened in the 2008. Now I think about it, it's same exact thing. The whole thing was starting to unravel and collapse as we had that election, and then we got Obama, and we don't need to get started on that one. So this is what's interesting is you're giving Powell credit, because I was, in the same camp. I said he needs to raise one more time. I was saying this at the last couple meetings, right? And to your point, the last two meetings we've gotten a pause, and that is not a full pivot. It's like getting it's like getting into the exit lane, but you haven't exited yet, and he may get back on the freeway. And if that's an analogy, metaphor that makes sense to folks, right? He might be able to get off and pivot, or he might just get back on and raise us one more time. And oh boy, would the FinTwit bros have a problem with that? They definitely don't want that. Or the real estate folks. Oh boy, what are those brokers going to do? No, so to your point, you're giving, I don't know, I don't think he has the balls. I don't know. You think that Fed Powell chair and the gang is going to come in and raise it one more time? And I want to say this too. I've been saying this to my audience. Progress for Powell or progress for the suits is pain for Main Street. So I'm of the opinion that they know they're squeezing out middle America, but they don't care, right? Your thoughts on that?
I think they want it to happen. They want Americans to go broke. And the stock market is going higher and higher because these funds and these banks don't believe that Powell is going to keep raising rates or hold them up higher. So he has to do something to regain control, basically. And because of that, as a power move, as a show of strength, I think that he will raise again if the black swan doesn't occur first. And I don't think it's gonna just yet because they are so well versed at pushing everything along further and further down the road. But I think you're right in your analogy, except instead they're not even in the exit lane yet. You know, they were in the left lane going top speed with the raises, and then he all of a sudden smoothed over 4 lanes, and he's just driving around in the right lane, cruising right along with everybody else.
That's perfectly said.
He hasn't even gotten in that exit lane yet.
Yeah.
You know?
Yeah. Perfectly said.
We're in for some serious issues here. Again, people underestimate the intelligence of the Federal Reserve and the Treasury and Janet Yellen and Powell and everything. They're not dumb. They act dumb. They're doing these things on purpose to harm the American people because it's the only way for them to maintain their grasp on the Ponzi scheme that is the fiat dollar.
Yeah.
It's the only way. So there is no choice but for them to continue on the current path. And they're holding those rates at the current levels, in my opinion, because they're expecting that black swan to hit at any moment now. But if the markets keep raging higher like they have been, I think Powell, grows a pair of balls, raises at least one more time before we, get too far into next year.
Yeah. Yeah. I'm going to put that into the title. Powell has balls. No, I love it. Okay. So we're of the same spot. So are we going to get another V-shaped recovery though? Because they're going to step in, bail it out, paper it over, everybody feel happy slappy, and we'll be rip roaring once again with inflation, but nobody will care because they'll have come in and saved the day. And is that kind of what you're thinking happens next year?
I don't think Americans can handle that because look at credit card debt, right? Credit card debt is literally at all-time highs. The interest rate is at highs we haven't seen in several decades. And then Americans' disposable savings, as well as the amount of money that Americans hold at banks currently in their savings account, is also collapsing very quickly because they're dipping into their savings currently just to maintain their lifestyle status and their homes and their cars and whatnot. When you've got all of these factors, and then you're looking at the recessionary period, the lack of demand, and the lack of demand currently for a lot of goods in our economy, a lot of imports and exports, Americans can't withstand a higher level of inflation without a collapse. So I don't think it's going to be so cut and dry this time. The Fed is backed into a corner. The central banks are backed into a corner, in my opinion, and they're going to bail out these banks. But when they bailed out FTX and Silvergate and SVB and all these other banks and crypto exchanges, that was inflationary. That hurt us all. We're all paying more now, and our kids and grandchildren for perpetuity are now going to owe more in government debt because that happened. And the more banks that become insolvent and the more bail-ins and the more mergers and consolidations of these banks that occur, the further that will push inflation and the more that will add to those measures. So I think people will care, and I don't think that they'll be able to withstand what they've withstood so far for the last 2 years.
Yeah.
To be honest with you.
So do you think, for me, I see the beginnings of the next crypto bull run, showing themselves, but I've remained hesitant because I still worry about stablecoin legislation, the solvency of these stablecoin issuers. It's been, suspected that Tether, Bitfinex had exposure to Evergrande. I was going to mention that earlier when we were conversing about that, but they've, vehemently denied that they have any exposure, but they also say that they're fully backed, right, as well. So there's still a lot to unravel in the crypto space. So although everybody in crypto YouTube and Twitter land is like, O-phase, clickbait, bull runs here, everybody pack their bags, go to the moon, I've been like, hey guys, this is a lot of fun, but remember everything over here that we've covered and how bad it is on the macro, how bad it is in the liquidity crisis, and how we still don't have legitimate backing by stablecoin issuers or regulations to go along with that, which presents problems for the crypto space. Now, especially when you look at how much Tether has been used and these stablecoins have been used to actually pump crypto. If those were to go away or to get scrutinized, that's going to be interesting to see the impacts of that. But I wanted to get your take on kind of where you see the markets heading next year based off of kind of what we've described taking place. Are we going to see the rally pick back up here after that Fed pivot? Or when that inflation starts to come back, is that going to lead to that next leg up in all assets, equities, precious metals, crypto? Or is it just going to be select? What do you see coming there?
Man, I'm glad you brought up Tether, because research that I've done in the past, videos and such that I've done with the former director for Fitch Ratings Agency, Dr. Marcel Metzler, he is a PhD economist. We came to the conclusion that Tether holds from what we've been able to conclude, that Tether holds a massive amount of Evergrande bonds and notes, which they cannot offload because nobody's buying. That's another part of the reason why Evergrande is so dangerous. To think that Tether is properly backed one-to-one, but never allowing anybody to see their holdings is an absolute joke. It's the same thing that we saw with FTX. It's the same thing that we saw with Bittrex. And I'm going to get a lot of hate from this, from the crypto bros, just like I got from a lot of the bull bros on the stock market. Tether, because of their exposure to companies like Evergrande and others like that, and their lack of actual one-to-one backing, will likely be one of the black swans that occurs in the crypto markets.
Yeah.
I definitely, truly believe that, without a doubt, in my mind. Mm-hmm. And this comes from, just like you, Zach, thousands and thousands of hours of due diligence and research that has led me to make these conclusions. And what will happen in the coming year? I'm looking at the black swan finally occurring here in 2024. For example, Dr. Michael Burry started to see these situation that was going to happen in 2008 in 2005. And he waited over almost 3 years, right around 3 years, in his positions while he was reaching out to the banks, and nobody believed him. Everybody thought he was full of shit. Banks and even AGI, I think it was, AIG, even, they're an insurance company. They weren't super heavily over leveraged, but they gave credit default swaps to Michael Burry because they didn't believe what he was saying. And they ended up going bankrupt, just like Lehman Brothers and Bear Stearns, because of the amount of credit default swaps that they gave to Michael Burry that made him filthy, stinking rich and made them go completely insolvent. And it took a period of about 3 years. Zach, guys like you and I and other people that are watching this video right now have been looking at this same thing since 2019, since 2020, since 2021, when we saw all of these signs happening with the RRP, the inflation, the money printing, the derivatives, and so on, right? We don't have to get into all the details now, but we've been seeing this happen. And the fact that the hyperinflation occurred and the federal rate raises have occurred have made it glaringly obvious that what's happening is can no longer be delayed for an extended period of time. We're in a situation where we need a black swan to reset the financial bubbles that have occurred in all these asset classes in order for the world to continue on a better path. So I don't want to see markets crash for the sake of seeing people hurt. I want to see them crash because the sooner it happens, the less people will be hurt. The longer that this takes, the more people will be negatively impacted. More homeless people. And I'm not talking about a few thousand. I'm talking about millions and millions of people, probably billions, are going to lose their homes, their cars, their entire life savings, their pensions, their 401ks, just like those guys in the trucking companies we were talking earlier, Matheson and Yellow Trucking. That's 30,000 people who had paid into their pensions for their whole damn lives and now have absolutely nothing to show for it at the age of retirement because their company is now insolvent. And the sooner this gets out of the way, the sooner we can move on to a path of recovery. And I think that's why people are just like, let's get it on already. Let's get on with it because we have to move along here. And I like you were saying, I definitely see a black swan happening in the very, very near future again, but with all the manipulation, nobody can pinpoint exactly when. So we're just going to have to keep sitting tight.
Yeah. Yeah, 100%. And I wanted to get, if you may, I wanted to get a couple of questions in on crypto too. I'm glad that you're speaking my language, Marcel, and I really have enjoyed this session. I got a couple more questions, and I wanted to see, so are you currently in any crypto positions? Do you like Bitcoin? Do you like XRP? What do you like in the crypto space, if anything?
As a matter of fact, I sold all of my crypto during the volatility of 2021 and moved it into certain other asset classes, into precious metals, into AMC, into GameStop, and so on, and then maintained a vast form of liquidity in order to dollar cost average down and so on, and even dollar cost average up on some of my investments and some of my businesses and such. So I currently hold no crypto, but if I did, I would definitely be bullish on the heavily shorted cryptos like XRP, even Dogecoin. A lot of people find that hard to believe, like, oh, this guy doesn't know what the fuck he's talking about. He's bullish on Doge. Like, yeah, have you looked at what happens with AMC and GameStop and Doge? Like, they run up and down at the exact same time. Have you looked at Bitcoin and the S&P? They move inverse to those, on purpose. As a matter of fact, again, in regards to Bitcoin, I believe that I'm very bearish on Bitcoin, regardless of its current price action. I believe that Satoshi is actually the CIA and the NSA. I believe that the current pump is currently only happening because BlackRock is buying up, now owns over 30% of all Bitcoin in existence in order to fund their exchange traded funds that are being processed right now. And I do believe that it will be a pump and dump. The economics and the value is not there. The low number of transactions per minute, the high cost of Bitcoin make Ethereum a little bit more attractive. But in my opinion, Bitcoin was the first, Ethereum was the second, and now other things like XLM, XRP, and so on, things that are right up your guys' alley, are what hold the real value in the crypto market for the long term. They, in my opinion, will be part of the central bank, what is used for central bank digital coins, as far as the implementation of the coin, the transferring of money, and so on, that will give them an incredible amount of value. And much like gold and silver, they're being artificially suppressed in order for the central banks and the big players to be able to pick up massive amounts of them right now over the years and leave, retail bag holders in things like Bitcoin and blue chip stocks and bonds.
It's funny because there's two data points that I just keep reminding my community about. The central banks around the world are buying more gold than they have in 50 plus years. And the number one cryptocurrency company that they are sitting down at the table with is Ripple. And there's already multiple CBDC pilots live on the XRP ledger. And so Ripple's already been in bed with them. And I've always said, hey, I'm not a fan of the CBDC. I'm not a fan of the 1984 scenario that's already playing out. But that's just the point. It's already playing out. And if I want to get outside of their system, I'm going to get outside of their system, but I'm going to be doing it with precious metals. Nowhere has crypto been, my ability to move outside of their system like so many people wanted crypto to be. To me, it's kind of a bet on, the New World Order coin, they call it, right? It's my bet on. I just look at it today. Today, the New World Order coin is the U.S. dollar, and the new U.S. dollar CBDC version, or whatever it's going to be, is going to be the new one. But you need a neutral bridge currency. That's where a XRP comes in. That's where a Bitcoin fails. And so you're right in the same camp with us too. We've looked over all this and we say, okay, there's a difference between real utility and there's a difference between just pumping something based off of a narrative. And it's interesting that to BlackRock, BlackRock, and you highlighting people losing their pensions. This is going to be such a bad issue. This is such a mess, like you said, with BlackRock being one of the largest holders of that Evergrande bonds, right? This is also one of the largest holder for the pensions in the United States as well. So the systemic collapse that's about to take place is going to be violent, and they're going to have to do even more to cover it up this time. It's like the crack keeps widening, and they keep on trying to, stuff something in there to stop it. And I relate it to a patient that's bleeding out and dying. You can keep on slapping on another bandage. They're still going to bleed out and die, right? And that's kind of what we're looking at right now. Now, what gets exciting, and we'll talk about this right now, where this takes these asset prices that have been heavily suppressed. I don't know if you're comfortable talking about some of I like to hang on the conservative side of predictions, right? I know a lot of people want to talk about crazy numbers for gold, for XRP. I wanted to ask you on GameStop and AMC just because I have no relation. I'm still new to understanding the stocks. And I wanted to see if you felt comfortable throwing out any sort of levels that you could see some of these assets going to, in particular, like AMC, GameStop memes, and then also gold, silver, and any others that you want to comment on. Sure.
It's wild that we've all come to these conclusions because up until today, you and I have never discussed any of this before, but our community, your community's here, my community's here. Yes, some of the people intermingle, but like you and I have never had a chance to speak before, and we've come to the exact same conclusions without ever having interacted in the past. So I think that should really show people a clear indication of how different people in different communities and even different investments can come to the same realization using different data sets and a lot of the same data sets, but without ever having interacted. I think that's absolutely wild. But again, as far as prices, okay, this is just my speculation, but off of everything I've seen, for example, I don't buy gold because I'm looking for the price to go from $2,000 an ounce to $2,200 an ounce. I'm buying gold because I'm scared that the price will go from $2,000 an ounce to $20,000 an ounce. And the same thing goes for silver. I don't buy silver because I'm scared. I want the price to go from 23 to 30. I buy silver because much like it has in the 70s and 80s and in the past, many times, I'm worried that silver will go from $23 an ounce to $800 an ounce. I truly believe that silver has a much higher percentage possible gain than gold. So I own a significantly more silver than I do gold. It has a lot more utility. You can't even make gold jewelry without it, for example, or electric vehicles, car batteries, solar panels, and so on. Even pharmaceuticals. And the same can't be said for gold. You need silver to make that gold also in refined form. So yeah, I think that silver has a more potential upside as far as percentage gains. And then as far as the volatility index, for example, the highest we've ever seen on the VIX, which is basically the inverse of the SPY. It measures the volatility of the volume of calls and puts on the SPY. The highest we've ever seen it, I think, was at $87. I definitely believe that it's going to more than double that price, and it should see easily $160, $180 on the volatility index when a real black swan occurs. And then you've got things like XRP, XLM. I won't give exact prices on that, but I do believe that they'll see new all-time highs as well. And then you've got GameStop and AMC. From what I'm seeing, all the research that I've done over the years, I wouldn't be surprised to see GameStop go to, a few $1,000s a share. And AMC, Yeah, AMC, after the 10 to 1 reverse split, the conversion of AMC preferred equity ape shares to common stock, and the increased revenues and profits that AMC has been bringing in lately and will continue to bring in the future, I wouldn't be surprised to see them anywhere between $10,000 and $50,000 a share. And people might think that I'm absolutely crazy for that. And that's okay. People can think whatever they want. People can think honestly whatever they want, because this is exactly what happened with Volkswagen in 2008. And Zach, and you know this, 2008 on October, I believe it was October 11th or the 13th, the S&P 500 lost 13% in one day. And right at the end of October, I believe, right around October 30th, due to the fire sale of assets, the margin calls that occurred, and Porsche owning 55% of the float of Volkswagen on 15% short interest, the price skyrocketed from what was at one point $30 a share to $1,000 a share. And it only stopped there because they made a deal between the hedge funds, the government, and Porsche to sell all of their shares to the hedge funds to cover their short positions at $1,000 a share. The difference is that there are over 4 million retail investors invested in AMC stock. There are only supposed to be 200 million shares that exist, but we have evidence of billions and billions of shares having been purchased and sold by crypto exchanges, as share locates, by shorts, by institutions, and by the 4 million retail investors. Therefore, there's no reason why, just like Volkswagen became the most valuable company in the world during its short squeeze, there's no reason to think that AMC and GameStop will not also become the most valuable companies in the world during a short squeeze situation. And the same thing goes for those other heavily shorted stocks in crypto, and precious metals and so on. So I'll leave it at that. To be quite simple.
Well, it's so funny because you say, 10 to 50,000 people can think I'm crazy. It's funny because in the XRP community, there's people that throw out $10,000 price predictions. And I've talked about it in the past too on, is that even possible? And it's just, here's where I'm at too. I heard that quote from Rick Rule. I don't know if that's where you got it too, right? I don't buy gold because I want it to go to 2,200. I buy it because I'm worried it's going to 8,000. Rick Rule was the first one I heard say that. And ever since I thought that's exactly it. I said, I don't know if XRP's going to go to $50 or 50,000, but I'm excited to find out. And I hold a crap load of it, and I can sell off some along the way if I need to. But I mean, for me, I've picked up these positions because I believe in the utility. For me, what I've invested in right now is utility with no counterparty risk. I have two businesses. I have my property service business. I have my media business. I have my silver on my savings side. That's utility with no counterparty risk. When I go to a little bit more risky bets, that's where I go into XRP and a few other cryptocurrencies. I don't own 20 different coins. I'm not, playing around with a bunch of memes. I'm invested in utility with, real partnerships, real ecosystems that can actually get somebody that matters to show up to the table and do a deal to actually adopt the token. Because as well as I do in this crypto hype, they do a photo shoot with somebody and then they call it a partnership. They're not using the token. They're not doing anything that matters. They're just friends. And so, for me, it's utility with no counterparty risk. On the conservative side, I stack silver for savings. But to your point, I mean, the gains are going to be pretty darn incredible, I think. But that's utility with no counterparty risk. I do it in digital form. I do it in physical form. I do it with my own businesses. And that's how I've positioned myself to ride out this storm. So any final comments from you, Marcel?
Cheers, Zach. I like that a lot. And when we're talking about those prices, I'm not talking about that's going to be their price forever, right? These are what we're talking all-time high prices. I wouldn't be surprised to see AMC reach up to 25,000, 50,000 a share and then settle back down after the short squeeze is over, or at least after it's been contained back down to $800 or $1,000 a share. That's without a question. And the same thing goes for the other prices, maybe with the exception of gold and silver, as they have actual utilitarian asset applications. I wouldn't be surprised to see them go hundreds of percent, if not thousands of percent, to the plus side and stay there, because that's happened multiple times in the past. Not once or twice, but several times.
What
for each
what
of them.
what do you say to the folks that say that silver can't go to these prices because we need it for our cell phones? You know, I hear that argument all the time. It's like,
Nonsense.
oh, an iPhone's going to cost $10,000 then, and
That's all the more reason why it would.
and I respond with, well, you're going to just do you're just going to finance that phone like you already do, and so you'll be able to pay that $10,000 phone over the course of 5 years. What's the problem?
Basically, yeah, everyone's going to be on the payment plan. Instead of paying $20 a month, they're going to be paying $80 a month for that damn phone or whatever it might be at the time, you know? And I mean, at the rate inflation's currently going, who gives a shit? It's going to be more expensive anyway, you know? But yeah, no, Zach, I think you're 100% right. And it's because of that manipulation that, we mentioned previously, it's because of all the manipulation that's currently going on in the equities markets that my partners and I have gotten together, and we've begun almost over 2 years ago now, back in September of 2021, we begun creating a stock brokerage, which is going to be a stock and cryptocurrency brokerage for retail investors by retail investors. And the whole point of the company is to pull orders out of dark pools. And instead of using Robinhood or Webull for retail investors to purchase shares, we are going to be taking the orders out of dark pools, not using payment for order flow through the price sorting dark pools, and running them directly into lit markets like the New York Stock Exchange. Because a lot of people have no idea that when you buy on Robinhood, your free trade's not free at all, you know?
Right. You are the product, right? Yeah.
You're paying for it. They're just putting a massive markup on every share, on every unit of crypto that you buy. There's a markup there, and you don't know what it is. You know if it's a penny, if it's 5 cents, if it's 10 cents. And because of that reason, Robinhood was forced to pay $65 billion in penalties to the Securities Exchange Commission, because the Securities Exchange Commission found that retail investors actually lost $34.1 million more due to the payment for order flow extra costs than if they would have just paid a commission, say $2 or $5 per trade, due to the payment for order flow that was occurring. So a lot of what's going on right now in the markets is the fact that they're taking your orders for stocks and crypto, and they're processing them on dark pools. Market makers like Citadel and Virtue are buying your orders from Robinhood and Webull, for example, using payment for order flow. They're paying a few pennies or microcents, fractions of a penny, more than the other stock exchanges, more than the New York Stock Exchange. Then they can grab a hold of your order, hold it, front run it, trade it in a dark pool, and prevent stocks like AMC and GameStop and PSLV, et cetera, crypto prices from going up. And then they can make money off the profit by shorting your stock or front running your purchases and your sales. So it's really further manipulation of what's happening. And precious metals, for example, are being traded 97% in dark pools, not the actual hard metals, but the paper units of silver and gold are traded by banks to the tune of 97% in dark pools. And that's literal price suppression. It allows them to front run trades. It allows them to stock up on gold and silver. And it keeps you from making money. It always harms the retail investor.
How much of that is happening with crypto as far as it being traded in dark pools?
Oh, a huge amount, because you can't go to the New York Stock Exchange and buy your crypto. You know what I mean? So it's all alternative trading systems and dark pools and over-the-counter trades that happen on paper. It goes from JP Morgan's desk to Bank of America's desk to FTX's desk and back 100 times, and it never hits the lit market. Occasionally, it'll make a slight change in the price there, but for a fact that they're front running your trades. As a matter of fact, the SEC just a few days ago filed a brand new lawsuit against Virtue Financial for doing that same thing and allowing their hedge fund, Virtue America, to have access to all of their retail trades. And then they gives them the ability to front run it. Virtue Financial processes 25% of all retail orders on the stock market. So if they can take your orders and process them into dark pool, then their hedge fund can front run your trade. They're making money hand over fist. Meanwhile, your positions are getting slaughtered.
Right.
So that's why we decided to start, our very own stock and crypto brokerage firm.
Right. So you guys are doing that, and that was kind of your inspiration. And I see the play on words there with the lit, because everything's happening in the dark pools where it can't be seen, and you're trying to bring more transparency. I really commend the effort, and I'm excited to watch your journey with that project. And I'll make sure to link that up down below. We'll have your Twitter below. We'll have the Twitter for the Lit Exchange down below. And then, is there anywhere else that people can find you?
Yeah, I'm on LinkedIn, Reddit, but mainly Twitter and YouTube are my main sources to get the information out to people, as well as our website, litexchange.com. There's no E at the beginning of Lit Exchange. So yeah, I really appreciate that, Zach. And the reason that I wanted to reach out and talk to you is because I wanted to inform as many people as possible about our stock and crypto broker. And I've had certain people try to call us grifters and such for doing something like this, when in reality, a grifter is somebody who tries to lie or scam or rob people of money. Well, all we're trying to do here is give people the ability to have their money make an actual difference on the price discovery of their stocks and crypto and their equities, because nobody else is doing this. They're all running our orders using payment for order flow to the highest bidder, allowing them to be front run, manipulated, and rehypothecated. And it creates a massive amount of failures to deliver and short positions and naked shorts in which we're all losing money. So we're coming out with our founders program here. We've been working the last 2 years and 3 months now on development, and we're finally going to be launching our founders program for Lit Exchange here, hopefully at the end of this month. We're just waiting for the final SEC approvals to be given to us by our attorneys.
Well, I wonder which will be approved first, the Bitcoin spot ETF or your exchange. We'll have to stay tuned for more, and we definitely will, Marcel. I'll link up everything down below. Make sure you guys go show some support and love to Marcel and his community. I want to shout out your community member that got us connected in the first place. Hopefully we can have you back. Clearly we had a lot to talk about, as we've now pushed it for an hour and 30, which is way overblown. But I really hope that people were able to take something away from this. And it is truly beautiful to see two unique communities with, coming to the same conclusion kind of on where this goes. And so it's been an absolute pleasure having you on, Marcel, and I look forward to connecting with you further and watching your journey with the Lit Exchange.
Cheers, Zach. Thanks a lot. Really appreciate you and your guys as well. Looking forward to discussing with you again. I've had a blast. I didn't even know it had been an hour and a half. So thanks a lot for having us.
Time flies when you're having fun. And folks, on the way out, if you could do us a big favor and like this video. If you're new, make sure you subscribe, hit that notification bell, and we will keep the updates coming for you guys. We will see you in the next one. God bless you all.